So this graph here is showing when the intrinsic value is relevant and when the time value is relevant. So on the x-axis you have the current stock price as 0, and then you have the option price or option value on the y-axis, right? So when the stock price is close to exercise price, right? So when the option is trading at close to money, right? That's when the time value is more important. If the option is deep in the money, right? If the option is deep in the money, then uh, and there is relatively small time remaining to expiration, it's unlikely that this option would not end up in the money at expiration. So at that time, having time on your side is not going to be that much useful. Similarly, if the option is deep out of money, like in this zone here, there is basically no likelihood that this option would pay anything. It's basically worthless even before expiration. Then having time on your side is not that beneficial. So it's in this area where the stock price, the current stock price, is close to the exercise price, where time value is of bigger relevance, right? So that is essentially what this graph here is highlighting. Okay, so I want to talk about these 6 factors that determine the option value. These 6 factors: stock price, exercise price, volatility, time to expiration, interest rate, and dividend payout. Together, they determine the price of the option, and these are the 6 factors that actually go into the famous Black-Scholes option pricing formula. So what I'm going to do is I'm going to talk about each one of these individually, talking about the intuition as to how each one of these influence the price of the option. All right. So what happens to the option price when the stock price goes up? What happens to the option price when the exercise price goes up? So we are going to look at each one of these factors individually, and in having that discussion, we are going to assume that only one of these factors is changing and everything else remains constant, right? So there are no sort of secondary effects here. So we will, if the stock price changes, none of these other things are impacted by that. We are looking at the pure effect of change in stock price on the option price. Okay, so so we are looking at the call option here. Okay, what happens to the price of the call option when a stock price increases, everything else being the same? So uh, this should be pretty straightforward, right? Call option is a bullish position. You basically make more money when the stock price goes up. So obviously, the higher the stock price, the greater would be the price of the call option. The payoff of call option is also ST minus X. So higher the ST, the higher would be the payoff, higher would be the profit. So higher the stock price goes, the greater would be the price of the call option, right? So here in our example, the current stock, you see the current stock price 166.76. At that point, the option price is $9.15. If this stock price goes up, this option price is also going to go higher, right? So that's the relationship between stock price and call option price. What about exercise price and the option value? So when the exercise price increases, the price of the call option goes down, right? Higher the exercise price, lower is the price of the call option. Again, you can see that from our example quote here. So let's keep the expiration same and see the impact of changing exercise price on option value. So this is September 160, this is September 165, and this is September 170 strike call option, right? So as you can see, for the same expiration date, as the exercise price is increasing, what is happening to the price of the call option, where here it is $9.15, but when the strike price or exercise price is 165, the call option price is 580, so it is lower. When it is 170, the call option price is even lower, right? So higher the exercise price, other things being equal, the lower is the price of the call option. There is an inverse relationship there. And in this case also, the intuition is pretty straightforward. Call option gives you the right to buy the underlying stock at the exercise price, right? You have the right to buy at 160 here, you have the right to buy at 165 here, and so on. The right to buy at a lower price should be uh, more valuable, right, or more expensive. So the right to buy at 160 should cost more than the right to buy at 165. So there's an inverse relationship between the exercise price and the price of the call option. Um, the next two, I think, are also quite intuitive, and volatility in particular is very important as well. We are actually seeing this in the markets right now. When the volatility is high, the option prices have actually gone up. What is the relationship between volatility and option price? Great. So to understand this, think about two stocks which are otherwise identical, but one is a very stable company. The price doesn't fluctuate a whole lot, and the other one is a very volatile stock, right? The price actually is very variable, it fluctuates quite a bit. The option on which stock should be priced higher, right? That's the question we are asking. So um, the more volatile the stock, the greater is the possibility of a big payoff, right? And therefore the price on that option should be higher. The higher the volatility, higher volatility means that the price can go up a lot, price can go down a lot. But again, remember, downside is limited, upside is unlimited for the call option. So the greater volatility is actually beneficial here for the option holder, because it increases the possibility of a big payoff. So higher the volatility, higher is the price of the option, right? So that's the relationship between volatility and option price. What about time to expiration? Well, it's kind of similar idea. If you have more time to expiration, there's a greater likelihood that the price can move in your favor, and therefore that option would be priced higher. Like again, you can actually verify this from this option code. So here what we are going to change is the time to expiration, keeping everything else constant. So we can actually look at this first four rows here. All four options are with 160 exercise price. What is changing here, of course, is the expiration date. And what we notice here is that further out the expiration date, the higher is the price of the option, right? So more time remaining, there's a greater chance that the stock price can go up, and that would be resulting in a higher payoff. So you would be willing to pay more for that option. So again, there is a direct relationship between time to expiration and the price of the option. Okay. The next two, interest rates and dividend payout. These are a little bit trickier to understand. What is the impact of changing interest rates on the option prices? So what I'll try to do is I'll try to explain this uh, as intuitively as possible. Let's first look at the impact of interest rate on option prices. So if you recall from our option payoffs, right? So those are here, option payoffs. Sorry, not on this one, it's on the other one. Yeah, so option payoff. This is the payoff for the call option at expiration, right? ST minus X if ST is greater than X, right? So if X is 160 and ST is 170, you have the right to buy at 160 and then you can sell it at 170. Your payoff would be $10. So ST minus X is the payoff of the option at expiration, right? So we'll start with that, ST minus X, right? So let me write that here, ST minus X is payoff at expiration for call option, right? I mean, that is if ST is greater than X. So if ST is greater than X. So the question is, how much value do you put on this? So how much value do you put on this payoff today, right? What is the value of this ST minus X today? So to compute that, of course, we need a present value of ST minus X, right? Present value of ST minus X. So what would the present value of ST minus X be? Well, present value of ST would be S0, right, which is the current stock price. So we are kind of looking at two things here: present value of ST and present value of X. So present value of ST is S0, present value of X, well, I'm just going to call that PV of X. Now you all know how present value calculation is done. If you expect to receive $100 in 1 year, what is the present value of that? Well, you take that $100 and divide that by 1 plus the interest rate or discount rate, right? 100 over 1 plus R. So we are looking at the same kind of idea here, like a simple present value calculation. Present value of ST is S0, that is stock price at expiration. This is stock price today. X is the exercise price, and PV of X is the present value of exercise price. So this is how much value you put on the option payoff today, right? This is the value of the option payoff today. So what would happen to this present value when the interest rate goes up? When interest rate goes up, so interest rate is higher, then present value would be lower, right? Remember, present value, the calculation, the interest rate is in the denominator. Present value of X would be like X over 1 plus R, or something like that. So R is your denominator. So higher the interest rate, higher is the denominator, and therefore lower would be the present value, right? So you already know this. There is an inverse relationship between interest rates, discount rates, and present value. So interest rate is higher, your present value of X is lower, and therefore S0 minus PV of X, right? So this is S0 minus PV of X. The present value of your payoff would be higher, right? So PV of X has gone down. So now you're subtracting a smaller number from S0. So overall S0 minus PV of X would be higher. So basically what this statement here is telling you is that if the interest rates go up, the value of the option payoff today would be higher, right? And if that is the case, then you would have to pay more for that option. Higher the interest rate, lower the present value of a strike price, and higher would be the present value of option payoff at expiration. So you would expect to get a higher payoff. You would put more value to that payoff today, and therefore you would be willing to pay more for that option. So that's the idea here, that if interest rate goes up, other things being equal, so again, remember, we are always assuming that everything else remains constant, higher the interest rate, higher would be the price of the call option. Okay, and then finally the sixth factor that we have is the dividend payout. What is the relationship between option price and dividend payout? And to see that, let's actually compare two stocks, A and B, one that pays a dividend and the other one that does not pay a dividend, right? And let's see what happens in that case. So let me see if yeah, so here it is. We have two stocks, A and B. Both are identical, both have same price today, both are similar in terms of their riskiness, so their expected return is same, all else is equal. The difference is that stock A pays a dividend and B does not pay a dividend. Okay, so today the price of A is 100, price of B is also 100, and your expected return from both of those stocks is also same. You expect a return of 10% from A, you expect a return from 10%, return of 10% from B also over the same time period. But how that return is coming is different. In case of A, the stock price is expected to go to 108, right? So go from 100 to 108, that's 8% gain in a stock price. And the stock also pays a dividend of $2. So overall, you're earning 10%, 8% from capital gains, 2% from the dividend, right? So you still make $10 here. Stock B does not pay any dividend, so entire gain of 10% is coming from increase in stock price. So stock price for B is expected to go to 110. So as a stock investor, uh, setting aside any tax issues for dividends and so on, you would basically be indifferent between A and B, right? Whether you buy A or B, you expect the same 10% return, same $10 gain for each share purchased, right? So stock investors would be indifferent between A and B, but option investors would not be indifferent. So the question is, as I've written here, all else equal, the call option on which stock would be priced higher, A or B? So again, remember, the payoff from the call option is ST minus X, right? ST minus X at expiration. So there is no dividend here. There is only a stock price. Higher the ST, higher would be your payoff, right? So going with that idea, it should be clear that the option on B would be priced higher, because if you expect B's price, stock price, to be higher in future, then ST minus X would be more for B, ST minus X would be smaller for A, and therefore you expect to get a bigger option payoff from B versus A. So as a stock investor, you might be indifferent between A and B, but as a call option holder, you would prefer the option on B over option on A. Option on B is more valuable than option on A, and therefore it would be priced higher, right? So what this shows is that greater the dividend payout, like here for A, the dividend payout is more, the option price would be smaller. Lower the dividend payouts, the higher would be the option price. So there is an inverse relationship here between dividend payout and option price. As the dividend payout increases, option price goes down, and vice versa. So these are the 6 factors that together determine the price of the call option, and these are the 6 factors that actually go into the Black-Scholes option pricing formula. So this is the Black-Scholes formula here. I included this here on the slides just for reference. You are not responsible for this formula or any calculations related to Black-Scholes formula. All right, but just for your reference, I've included that here. On the left hand side, you have the price of the call option, so that is this C0, and on the right hand side, you have those 6 factors that we just talked about: stock price, exercise price, time to expiration, dividend payout, and so on, and the volatility and so on, right? So those 6 factors together included in this relationship, and together they determine the price of the option, giving rise to this famous Black-Scholes option pricing formula. So you're not responsible for this Black-Scholes formula or any calculations related to that, so you can skip over a couple of these slides here. But one thing that is very important for any investor to be aware of is this concept of implied volatility. Okay, implied volatility, and this idea of implied volatility is actually based on the Black-Scholes formula. So that is something that I do want to go over, and I want to make sure that everybody understands what this implied volatility is and what is the significance of implied volatility.